I'm about to make the statement of the most dangerous words that are ever said in investing. This time is different. Market looks really expensive. How do we know when irrational exuberance has unduly escalated asset values, which then become subject to unexpected and prolonged contraction? If you had followed his advice of doing anything, you would have missed it. Nobody rings a bell at the bottom.
They think they're going to make $1 trillion in revenue in 2027. They've got a $500 billion backlog right now. The problem is there's not enough electricity to power them all. We can't plug anything in because there's no electricity.
The fear sitting inside of people right now is AI is going to take my job, somebody who wants to put a data center in space.
An insane valuation for, by the way, what is probably a really, really good company, and not a very, very good company to buy, I would say.
We'll experience a 25 to 30% down market. It will happen.
At some point.
It's almost like Christmas morning, but it's not December 25th. All we know is Christmas morning is coming. I don't know that I've ever been rooting for a bear market so hard as I have. I want to get it over with. All right, everyone, thank you so much for joining me. I'm Eric L. Dunavant, president and founder of Paradiem. I'm joined by Carson Rich, our senior research and trading associate. This is our third quarter portfolio overview and outlook. We're going to just kind of go through everything that happened in the second quarter, talk a little bit about what we're seeing, what we're watching, and then also talk a little bit about what's coming ahead. And so we'll spend the next 30 to 45 minutes doing all of that. Before I dig in too far, let me read this one. Today is going to carry, you guys know we have to make the lawyers happy in the beginning. This one's going to be a little bit longer because we're going to get into a little bit deeper than we even have on some of our other presentations. And so if you're watching live, stay with us. This may take me like about a minute to read, and I apologize. If you're watching on YouTube, watching a replay, you can click ahead, but I do need to read all of this. So Paradiem LLC is a registered investment advisor. This webinar is for informational and education purposes only. The information presented reflects the opinions of the presenters as of the date of the webinar and is subject to change without notice. Nothing discussed during this presentation should be construed as personalized investment, legal, tax, or accounting advice, or as an offer to buy or sell any security. Any discussions of specific securities, companies, industries, or market events is provided solely to illustrate our investment philosophy or market commentary and should not be interpreted as a recommendation or solicitation to purchase or sell any particular investment. References to specific investments are not representative of all investment decisions made by Paradiem and should not be assumed to be profitable. Any portfolio performance discussed during this presentation is presented for informational purposes only. Past performance is not indicative of future results. All investments involve risk, including the possible loss of principal. There can be no assurance that any investment strategy will achieve its objective or avoid losses. Market conditions, economic trends, and investment opportunities are constantly changing. Opinions expressed during this webinar are based on information believed to be reliable at the time of the presentation, but are not guarantees of future events or investment outcomes. Before making any investment decision, investors should carefully consider their own financial circumstances, investment objectives, risk tolerance, and consult their own financial, legal, and tax professionals as appropriate. Additional information about Paradiem, including our investment advisory services, fees, and important disclosures, is available in our current Form ADV Part 2A, which is available upon request. I feel like I need to take a nap because I think I just said everything that we're about to talk about.
Yeah. Well, I'll give you a break from talking there if you want me to kind of go into what I saw happen in the second quarter of this year. We saw the S&P 500 and the NASDAQ both have their best quarter since 2020. It's been 6 years since 2020. It's been kind of hard to believe. But and that came from most of that comes from the anything related to the news of the war. The stock market had a bit of a correction in quarter one. We talked about that in our last webinar. And we sort of had a rebound, and mostly a tech rebound. Mm-hmm. And I'll get more into that, into the specifics of that tech rebound and how we were positioned. And, we don't have our numbers yet for our audit for this quarter. Nope. Just yet. I can tell you we did pretty good from our internal tracking from what we saw. So I want to talk about sectors, if that's okay, if you don't want to cover anything first.
Well, I do actually, if you don't mind. I want to get into sectors, but I want to talk a little bit about just like where we are, because let's take a step back. One of our key thesis is think like an owner. Mm-hmm. And I do want to kind of talk about like how would an owner look at what's going on right now? Because we've been in, I think the statistics, and I wish I could find the source. I've been looking for the source. And if I find it, I will make sure that we get this out there. But I believe that if this year finishes up, it is only the second time that the market has had 4 years in a row of increasing returns. I don't know if
we've had 5 in a row twice.
But I think, okay, so maybe that went along with the 4. I think we've only had 4 in a row.
I don't think I think the 4 and the 5 are the same there. I think almost, both times we got to 4, we got to 5. Not saying that we will this time, but
right.
But yeah, 5 has only happened twice. I do know that. And
so like the last drawdown that we had was 2022. The market was down about 25%. The market kind of, I think, defined as S&P 500 was down about 25.4% that year, and then we've had 3 really, really strong years, all double digit. Again, go the S&P 500 with dividends reinvested, 2023, 26%, 2024, 25%, 2025, 17.9%. And I think roughly, again, if you look at where we are, right around 10% on the S&P 500 to finish.
Just under 10.
The second quarter.
Year to date.
Year to date. And so when we look at all of that, there's a lot of people who, including us, who would say, hey, oh my, the market looks really, and we go look at price to earnings ratio, market looks really expensive. So as an owner, you would go, okay, so what do we need to do to maybe be more cautious? Or what do we need to do to be more careful? And I think that this is the one place is like, we've got to think like an owner, but we've also got to know the market environment that we're in. And so I want to share this with you guys because there's a lot of people, especially that are older, you probably won't remember this because I was really, really young in my career. You might know this from a research standpoint, but this is in December 5th of 1996, Greenspan, who just passed away, who was one of our Fed chairs for a long time, made the following comment. Before the tech bubble. How do we know when irrational exuberance, and that became the word, irrational exuberance, has unduly escalated asset values, which then become subject to unexpected and prolonged contractions? So he came out in December 5th, 1996, talking about irrational exuberance. This market's way too overvalued. Oh my goodness. And so there were a lot of people who was like, we need to do something. We need to do something. And I think from a pressure standpoint, I would say, I feel that. I sense that. I look at valuations and I say, man, okay. But I think we've been behind the scenes doing a lot of research. Like, are there any patterns that we can see? Is there anything we can look at? Is there anything we can know? It's like, man, there's not really. But here's what I thought was interesting these are the facts of what happened. Greenspan said that on December 5th of 1996. At that point, the S&P 500 closed at 739. The market bottomed on October 9th of 2022, over 5 years later. So he says irrational exuberance. It took 5 more years. When the market bottomed, it bottomed at 776. He made that comment at 739. The market bottomed after going even up further at 776. If you had followed his advice of doing anything, you would have missed it. Because you were better off just holding and then going down to the bottom of the tech bubble. It felt awful the entire time.
And it felt long, probably.
It felt really long. And you didn't even know. I mean, we can look back and go, the bottom was October 9th of 2000. Nobody rings a bell at the bottom. So nobody knew it was the bottom at that point. And so this is the reason that we emphasize any money that you need in the next 5 years, don't put in the market, but everything else we want to be fully invested. And so it's like, well, what should we be doing? Things are expensive. And so there's small things that we're doing on owning, like we've encouraged people to have more in the dividend portfolio than in the growth because dividend has typically been less volatile. Not that it doesn't have any volatility. It's been less volatile than the growth portfolio. So we've been doing some small things, but it's not, you can't look at a market and go, hey, we should just get out and then we'll get back in at another point. And I think that's the hardest part of where we sit right now, because if you would have asked me 2 years ago if I thought we would see the markets up as much as they are right now, I don't think I would have said that. And so I just wanted to add that commentary. And we can get into sectors because I think it's also worth talking about, because the second quarter looked completely different from the first quarter.
It did.
And which means the third quarter will probably look completely different from the second and first quarter. So I do want to talk a little bit about sectors, but I wanted to give that perspective because I think that's on a lot of people's minds as we're coming in. Yeah,
and a lot of what I'm going to talk about in a second ties into exactly what you just said, actually. And so you look at PEs. Now, we aren't very fond of buying the market as a whole. We don't buy like a total stock market index or even the top 500 companies. So we don't necessarily have the problem of owning the price to earnings ratio that the market as a whole has. Right. What's really interesting is you'd be surprised that so far this year, the Mag 7, which is really the top 7 stocks, the top 7 by market cap, or close to that, they're trading at much lower price to earnings ratios than their historical average. So it's almost as if the S&P 493, you could call it, minus the top 7, it's like everything else is overvalued. And a lot of that comes from hardware. And we'll talk about that in a second. So my point in saying that isn't buy the Mag 7 right now. It's that there are things that are actually undervalued while the market as a whole is overvalued. So what's the opportunity is, well, if you were going to buy something today, it would probably be better to buy something that's a bit undervalued than owning the market as a whole. And that's one of the reasons that we don't just buy the market as a whole, because we have more flexibility.
Well, it goes back to I'm just keep leaning into our philosophy, right? Simplicity over complexity, and then research reveals opportunities. This is both of those coming together. Simplicity allows us to really concentrate down and say we want 25 dividend stocks, we want 25 growth stocks, and then research reveals opportunities allows us, and we'll talk more about the research and kind of what it pulled out, but really allows us to go in and say, okay, based on what we're saying, here are where the opportunities appear to be right now, which is what you're talking about. It's like from a valuation standpoint, there's some opportunities that are jumping out.
By the way, do you know what I believe right now it's the only Mag 7 stock that has a higher valuation than the S&P 500 is, if you had to guess?
I'd guess NVIDIA.
Tesla.
It's
got a 200 price to earnings ratio, and it stays up there. And I'm bringing that up because we're going to talk about SpaceX, Elon's other companies in a second. But yeah, NVIDIA is actually pretty cheap right now from a valuation standpoint. But so here's what I want to talk about with
sectors. That's not a recommendation to buy.
No. Don't buy NVIDIA based on that. Just an observation. So I'm going to peek at my notes here so I can tell you about the sectors and what we've seen so far this year and this quarter. Tech led the quarter. Tech led quarter 2, and there's subsectors within those sectors. I'm not going to get into too much of the nitty gritty. I'm going to tell you that hardware specifically is what led this sort of mini tech boom in quarter 2 that led to the S&P 500 having its best quarter since 2020. Leadership rotated later in the quarter, so really almost at the end of the quarter, we sort of had a broadening out of industrials, financials, and healthcare. Energy lagged this quarter. Energy was number 1 in the first quarter, and that was, if you think about what was going on with the war and oil prices. So here's year to date is an interesting thing to look at because it does change quarter to quarter. Sort of the leadership between the sectors changes quite often. Year to date, tech is still number 1, but they were down in the first quarter. So the point there is tech moves when it moves. Industrials is second, energy is third, and materials was fourth. Now, one of the reasons our dividend portfolio has been doing so good year to date is if you look at our top 4 sectors by weight right now, it's industrials first, tech second, materials third, and energy fourth. So out of the 10 to 20 sectors you could argue that we could choose from, we have essentially the same 4.
Let's talk a little bit about the dividend portfolio if we can, because I've fielded a few emails, I've had some phone calls with people, and I want to talk, because if you're a person who says, hey, I like what you guys are doing, and I'm just going to let you guys go do it, and I'll look at this about once a year, you're not going to notice anything that I'm talking about. If you're a person who looks at your statement balance every single day, you're going to see some nuances of what we're going to talk about right now. And so in the first quarter, the market was down. So S&P 500's down, I think about 4% if my memory goes correct. And I think the dividend portfolio was up about 5%.
Correct, yeah.
Right? So we're sitting in the first quarter going, woohoo, this is great. This is wonderful. In the second quarter, that leadership shifts. But we're already ahead of where we expect to be. The leadership shifts. In the second quarter, dividends themselves, I'm not talking about our portfolio, our dividends severely underperformed the S&P 500. And we'll wait for the audited numbers to come in. And if you want to have a specific conversation, we can, because I'm going to speak in generalities right now. But the S&P 500, between our dividend portfolio, the dividend index, and the S&P 500, the S&P 500 far outshined in the second quarter because of this rotation that you're talking about. But the dividend portfolio was already ahead. And then the dividend portfolio did better. It didn't quite do as good as the S&P 500, which is what people noticed in the second quarter. Like, hey, the market's going way up and we're not going up this much. And so it lagged the S&P 500 a little bit. But this is why I'm waiting for the numbers. We majorly outperformed the S&P. Majorly outperformed the dividend index. So if you're just looking at dividend stocks and how dividend stocks performed during the second quarter, the dividend portfolio did quite well. But if you're comparing it to the S&P 500 that quarter, we had some people who was like, hey, what's going on and what's happening? It's like, well, if we look at this, and again, we're looking at the whole year, not just at a quarter, but that's where the rotation gets to be interesting and why I think our philosophy of not only simplicity over complexity, but research reveals opportunities. The research is showing us where to go. It's not 100% right all the time, and rotation happens. But if we're only looking at dividends in that quarter, it still was a great quarter for what was happening. And so I think that's where we have to kind of take this as a whole big picture, not just as a smaller picture. The other thing that was really interesting is I also talked to some people early in the first quarter who, depending on where they were, they had maybe a portfolio that was heavier in dividends and they had a portfolio that had some of the growth. Well, growth really struggled in the first quarter.
It did, yeah.
But it had an incredible second quarter. So in the first quarter, I had some people who was like, well, why is this portfolio so much more outperforming this other portfolio? And they're having exactly the opposite conversation at the end of the quarter. But I believe, and this is where the number, some of this I'm transitioning into because the first of the month here has been a little bit, it's beaten up on growth a little bit more as the month has started as opposed to the end of the quarter. But I think when it was all said and done, growth was not that much farther ahead of dividend, apples to apples comparison, but both ships had risen. And so we're going to talk about sector rotation and everything like that. But so many people, if you're watching your portfolio on a day-to-day basis, do know we don't own the markets. But we're being very intentional about what we do, and make sure that you're looking at the whole picture of what's happening, because it's what we're doing on a daily basis. And I would tell you if things were not going right. But to this point, what we've been doing, I feel very strongly about. We've just seen it's just rotation in the market. And that's probably the biggest problem with media. Media is not going to tell you what's really going on. They're going to tell you the headline, and then you're going to feel like you need to follow the headline. So I make all of that because I think it sets up where kind of you're wanting to.
Yeah, absolutely. Oh, that's great. And so what I want to do now is, so I shared those top four sectors that are up year to date is industrials, tech, materials, and energy, and that's what we've held for the majority of the year. Now, watch what the difference here is for what we're going to do in the third quarter. Is we're going to be industrials first, tech second, financials third, and software fourth. So the difference there is you're seeing financials and software in our top four. And this is the rotation aspect of what we're talking about here. This is what I'm really excited to talk about. And none of this is a prediction or a buy recommendation by any means. But I told you that we had, because of this tech resurgence, this tech rebound, you can sort of dig in and to see, what's sort of causing that. It was hardware. And so if you think anything related to AI chips, anything of that nature, or even the picks and shovels, which we love, which is right. Lam Research is one of our favorite picks and shovels. We've got Keysight Technologies in the growth portfolio that's picks and shovels. Still hardware because they build machines that help in the industry, right? But so what happened was we had a tech rebound, but it was all hardware, and they left software in the dirt. Now, if you remember, towards the beginning of the year, we sort of had software while the market was, up and down. We had software enter its own bear market by itself. It was the worst performing sector at the time. The software ETF, IGV, that I track was down 35% at one point. And that was because of some AI developments, and it is true that the theory that AI would replace a lot of software companies. I think that is still true. We sold a software company because of the thesis of we don't want to hold something that the reason we bought it is no longer a valid reason.
Absolutely.
But guess what? There's great software companies right now that since they moved together, there's great software companies right now that I believe are mispriced. If you look at their current valuations, their current prices versus history, that are actually going to be, in my opinion, not hurt by AI and actually be distributing AI, sort of riding along with the AI wave. But so if you're going to participate in AI, let's say if you were, you probably wouldn't want to buy chips right now because they're at, super high valuations. Probably at least consider something that's at a much lower valuation than historically. So software is something we're really interested in right now. So software and financials, yeah, we're going to be higher weight than we were before. For that reason. Anything you want to cover before I go into some of the...
No, everything you say so far makes sense.
Yeah, so here's what we're doing about it. We've got ADP, which is automatic data processing. They're a payroll and HR company. Great company. I think they'll do well for a long time. They're significantly undervalued to their history, about a 21 price to earnings ratio versus a 28. Been paying dividends for a long time, but anyways, we've held that company for a few quarters in the dividend portfolio. We've already got it, and then SS&C also in the dividend portfolio. So what do we do with those stocks? If we sort of go where our conviction lies. So we'll raise those weights a little bit. That doesn't mean they're 30% of the portfolio. It means we raise them a little bit because we're higher. We have more conviction in them. Then we're adding to the growth portfolio ServiceNow and adding to the dividend portfolio S&P Global. Now, S&P Global is a fantastic company from, in my opinion, trading at its lowest valuation in its public history, which is a crazy thing to think about. ServiceNow close to it, by the way. So these are massively undervalued companies that just got hit from AI news. And if you follow the logic behind it, it makes sense in some cases for some stocks to get punished. And then where the opportunity lies is in the stocks that got punished even when they probably didn't deserve to get punished. So
let me, my compliance brain's going crazy real quick. So I'm just going to tell everybody. So we're filming all of this early in July because of some travel and some other things like that. So we're filming a little bit earlier. We're going to be playing this on July 22nd. Everything that we're talking about right now is based on current market conditions, based on what we're seeing. So you want to, if somebody's looking at these companies, you want to have a conversation with your advisor or whatever before you think about you actually buying these. What we're trying to explain is what we're seeing right now as we're making these positions and these changes. So
absolutely,
this is not like, again, we've said it over and over. There's not specific recommendations of what you need to go out and do, but it is what we're doing and why we're doing it. I just want to make sure we reiterate that before we get too much further.
Absolutely. So I also wanted to talk about the rest of the AI trade, and then we'll get into the IPOs because that's a big theme. So,
well, no, let's talk. I mean, I want to talk about that part of the AI trade if we're going to head in that direction. But I mean, it's really, this is about the fact that there are times when we go and look at the portfolio, it's like, okay, so certain things are leading. Let's go back to the research reveals opportunities, and research reveals opportunities tells us, hey, this sector of the market got beat up maybe more than it should have. There's a potential misvaluation going on here, and this is where we want to step in and use that to see the potential opportunity, which is why you're seeing these things in the software area where total tech's getting beat up, but software is getting maybe a little bit more beat up. And there's some good reason of why maybe areas of software got beat up. But what I'm hearing you saying is everyone got beat up and not necessarily everyone needed to get beat up. So let's go look and pick and choose through. There are some companies that are sitting inside there that are kind of diamonds in the rough that we can kind of go in and say, hey, this still looks like a good company that has still good resilience, that even though they're in this category and they got beat up, we can buy it here and use this opportunity to make the
Yeah.
purchase. And that's really more kind of what we're seeing on those, right?
Yeah, exactly. Like ServiceNow and S&P Global, for instance, growing revenue by double digits a year for a while, and continuing to grow even though their price gets cut in half is at least something to think about.
Well, no, and I mean, I think that's what was interesting is we were doing this when we were doing this in the investment committee meeting and just kind of looking at what are the, if we talk about the valuation of a company, basically, if you went into this, what you're looking for is how do we go into a store and find the things that are on sale? And we were just using a metric that says, hey, based on the metrics that we're following and looking at, these things look like the price has been marked down, and it's a really, really good value.
Yeah. Absolutely. And so I want to talk about the chips and the warehouse paradox.
Let's do that.
Which is what I'm calling it, what I'm referring to it as, is NVIDIA is still beating every quarter, it seems. It seems they beat by an unprecedented amount every quarter. They keep selling more chips. Their guidance is insane. They think they're going to make $1 trillion in revenue in 2027. They've got a $500 billion backlog right now. The backlog keeps growing, so they keep selling stuff. The interesting thing is where the stuff is going, because we've got all these data center plans. A lot of companies, they call them the hyperscalers, and other companies are building all these data centers for the purposes of AI and cloud storage and things like that. The problem is there's not enough electricity to power them all. It's not even necessarily there's not enough money to build them. It's not even that there's not enough chips to make the data centers. That was the case for memory chips this past quarter, which is why if you've seen anything about the memory stocks, absolutely ripping. That was part of the hardware trade that I was talking about, those memory chips. But the problem here is, and Microsoft even publicly said this, they said, we've got all these chips, we can't finish these data centers. We can't plug anything in because there's no electricity. There's not enough electricity. So a third of what was supposed to get built, or at least started building, has actually started making progress. So, and then this is the diamonds in the rough kind of thing. There's a company called Constellation Energy, and what they do is nuclear power, and they're signing deals. They're creating backlogs. They're signing long-term contracts with the major companies in AI, but they're trading at a significantly lower valuation than historically. They're growing their revenue by double digits. Again, they're a good dividend stock. At least they've been paying and growing their dividends over time. But yeah, they've got 20 nuclear power plants. They're the largest nuclear provider in the world. And their stock price has taken a significant dive. So it's sort of, you're saying this is as of right now, this is what we're doing and why. I think that's another interesting one to touch on. So it seems still that the bottleneck is energy. Last quarter, we had the same thesis. What we did about it was we bought a copper stock because you need copper for energy. And then the idea was also, NVIDIA is talking about there's also this new technology, these optical interconnects, almost using light in place of copper. So we bought two companies in the growth portfolio that are growing that part of their business. And that's something we still believe in is the optical interconnects and the copper, and we've got a nuclear stock that we're adding in the dividend portfolio now. So
and I think that what's interesting as we look at this is I'm about to make the statement of the most dangerous words that are ever said in investing. This time is different. Yeah. Which is what is it. This does not give us a reason to act. It gives us a data point to look at, which is, so when you go back to, when we talk about the tech bubble, is like that was a lot of dollars chasing a lot of things, but no bottlenecks anywhere, right? They were just throwing dollars at almost anything that could potentially be profitable.
Anything with .com.
Correct. Right? That was a lot of what was going on in the tech bubble. So to come in and say, well, this is exactly the same as the tech bubble is a place where we've had to have more caution, because part of the problem we're running into isn't that they're building all the data centers that they want to build and they're overbuilding them and, these chips are just going to random places. they have a backlog. They can't get all the energy that they want. Like the demand for what is trying to be built can't be fulfilled, and that is causing prices to rise.
Yeah.
The risk would be if somehow someone came with some huge breakthrough that solved an energy problem or solved a breakthrough and like where the chips could go. I mean, that's where that breakthrough happens, is solving the bottleneck. But right now, while that bottleneck exists, I think that's the one thing you're like, what could keep things going higher is that.
Yeah.
Is the fact that there is a bottleneck. This isn't just random dollars going out to just anything.
And I'd be curious, Eric, to see how the market would react if we get through the current backlog that NVIDIA has, and then we still haven't been able to build the data centers because we still don't have enough energy, and so people stop ordering chips. Now, I don't know if that's going to happen.
Right,
but
no, that's a risk.
So these are things that we think about as an.
But I'm going to ask a hypothetical question you may not know the answer to. But wouldn't that fundamentally? I mean, the fear sitting inside of people right now is AI is going to take my jobs and this and this. That presumes that AI could continue to grow and do things. There's certain things AI can't do today. Well, AI can't do it today because there aren't the data centers to support the AI. There's not the energy to support the data centers. So if those are the dominoes that need to fall over for the problem to really exist, does it mean that potentially what we're looking at is the problem that people are trying to foresee about what AI is going to do is actually extended out further because you can't get to the critical mass of what it would take to even cause that problem right now.
Yeah, as of right now, we're taking longer than expectations going back even last year to 2024. We were supposed to be ahead of where we're at now. So it's definitely the process is being slowed. Now, some of that is on purpose because I was telling you this yesterday is the CEO of NVIDIA has been trying to get Taiwan Semi, which actually literally makes the chips. NVIDIA is the design firm, but they've been trying to get Taiwan Semi to make more chips faster so they can make more money faster. Now, maybe that's a good idea from an earnings perspective because you can say that you made more money. I don't know, but I don't know. Is that a good idea if a lot of the chips are just sitting in a warehouse and not able to be used because there's another problem that has to be solved right now? So I don't know. I would be on the side of Taiwan Semi.
I know. I don't see any reason to make more chips. But I mean, like you said, the thing to watch is if we start to see orders decline. It really is, where does the backlogs then start causing? Because I'm gonna then lead us into the next discussion, which is the IPOs that are coming and things like that, because we do have an IPO that just happened from somebody who wants to put a data center in space. So,
Yeah, that is true.
But I mean, we still face the backlog problem. I mean, and where do you get, I mean, can you fund all of that? Can you do all of that through solar power or whatever? But I mean, it's an interesting time to be alive right now, just to watch everything that's happening, because this time, at the end of the day, this time is not different. And what do I mean by that? We'll experience a 25 to 30% down market. It will happen. At some point, At some point, it'll happen. We probably won't expect it. It probably will happen faster than we want it to. Again, it's no reason to panic. It is what it is. I thought this was beautifully said in one of the pieces that we read. But when you look at, let's go back to, we said the last down market was 2022, and then it led into, we've had 4 spectacular years. Well, if what it took to get the next 4 or 5 spectacular years was a good 25 to 30% down, I think we'd all take that.
Yeah, get it over with.
Get it over with, rip the Band-Aid off, because that's just how the markets work. So we have to kind of bleed it out. And I also believe that our research reveals opportunities would help us also go in and go, okay, so it would help prove certain thesis. It would help us see if we've got any exposure to areas where our thesis is wrong, and help us to really kind of correct that. And so I think one of the things I've told Carson and I tell a lot of other people is I think you learn so much better about how to be better at what you do when things are bad than when things are good, because you can sometimes accidentally get lazy when things are going well. And I keep pushing Carson and our other advisors here is like, no. Just because things are good doesn't mean that everything's good, and we don't need to be paying attention. But I don't know that I've ever been rooting for a bear market so hard as I have, just because I want to get it over with. It's like everyone's anticipating. It's almost like Christmas morning, but it's not December 25th. All we know is Christmas morning is coming.
Yeah.
And everybody's like, well, I want to open the present. I want to do it. I have no idea when it's coming.
Yeah.
So let's talk a little bit about the IPO wave, the big name that's out there. So this is not a recommendation to buy. So we're going to talk a little bit about SpaceX because people have been asking, and the other IPOs that are coming. So let's talk about it.
Yeah, so this is a company with around 2 billion or so shares. They raised $75 billion. They got it instantly by IPOing only 500,000 shares. So there's a lot left, and we're going to talk about the lockups. But the interesting thing from the start, there's many interesting things about this IPO, but one of the interesting things is NASDAQ changed the rules to where you used to have a minimum float of, I think, 10% of the shares, and you used to have to wait 3 months, and there is a market cap limit. I don't remember what it is, but they changed the rules essentially right before SpaceX IPO'd, and then guess what happened yesterday on July 7th is SpaceX was added to the NASDAQ 100. So they are now a NASDAQ 100 company at a, $1.5 trillion to $2 trillion valuation, something like that today, trading at 150 times sales. So that's revenue basically. If you look at you want to guess what their net profit is for? Do you know what the run rate is?
I don't know.
It's negative something.
I was going to say it's negative. Negative was my guess. Yes, they're not making money.
Negative. So an insane valuation for, by the way, what is probably a really, really good company, and not a very, very good company to buy, I would say, in my opinion, right now, based on everything I just shared. But if you think about what they're doing is they've got Starlink as a part of SpaceX. Yeah, they're sending rockets. They're shooting a massive amount of rockets from, I guess, Florida and Texas, testing things out. He wants to build data centers.
Well, I mean, the reusable rocket. I mean, there's a lot of innovation that has come out of what they've built.
Great, exciting company. You just can't get too excited and want to buy into something because what happened was it did sort of round trip. It IPO'd at 135, I believe, per share. It went all the way up to close to 200 and came back right down to the IPO price. And
it'll be interesting as it gets listed. I mean, you've got the one thing that they did that Musk and the team did in getting the NASDAQ and everyone to change the rules is they built a little bit of a floor into their price.
Yes.
Because these indexes because it's in the index funds and everything else have to buy a piece of the company. Yeah. They have to.
There's a lot of 401ks and retirement accounts that by default are going to buy SpaceX, for instance, because it's in the ETF. And 500,000 shares is not a lot of shares. So it would seem as though now that there would be we could guesstimate that there would be some kind of floor. The last thing I want to talk about for SpaceX is the lockup period, if I can, real quick.
So this gets to be important. So I'm going to just give a simple lesson. This is our caution on most IPOs. It's our caution even on SpaceX, is that for the first 1 or 2 years, you're not seeing the total picture of what it looks like for a company to go public because they only take so many shares and take them public first. And then a lot of the insiders are locked up for a period of time. So over that 6 months to a year to 2 years, depending on what you're looking at, if price is based on how many shares are available, if you don't have that many shares available, you could really drive the price up. But then if you hit a period in a window where more shares become available, if there's not enough buyers, the price could drop. And so we've seen that with a lot of IPOs. So I kind of have this general rule of thumb that I don't like to really look at an IPO until it's at least 2 years old. And that has nothing to do with SpaceX, it has nothing to do with the other IPOs that are come out or IPOs of the past. It's that I've seen more times than not that waiting allowed us to get in at a better price and see truly, is there profitability? Is this company making money? Are we overpaying? And so as you talk about the lockups, what you're about to talk about is the shares that are going to be coming back online over the next, year?
Yeah, so keep in mind something like 2 billion total shares with 500,000 of them being public. So what we've got here is, and what we're used to seeing, by the way, I can't remember if you just said this or not. We're used to seeing about a 6-month period, and then a majority at least of the shares are unlocked. So we've got them releasing in stages. So 20% of the rest of the shares unlock after Q2 earnings, August, so next month.
Wow.
20%. And then you've got 7% more of those shares at tranches between 70 and 135 days after IPO, and then the rest at the 6-month mark, at the 180-day mark in December. So essentially all of them would be unlocked at what we're used to seeing in 6 months around December, but we've got 20% coming very soon in August. So in the .com, I'm not saying this is my prediction by any means. There was a lot of major IPOs and major for the time. In terms of dollars, they weren't major in today's dollars, but you get the point. In 2000 or before, a lot of these major IPOs came and they all had .com in their last name, and they all were awarded hundreds of, times multiples for their sales and their earnings, and if they had any, probably didn't. And then And so what happened is whenever those shares flood the market, specifically what's happening with SpaceX, we just talked about, is it's now in an index. It's now going to get bought by default. To buy it, you have to sell something else. Yep. So you got to sell, the higher weighted stocks in the index to buy. You see what I'm saying? You've got to trim those down or completely sell out of something else. So it causes a rotation. That's sort of a theme that we're talking about. Now, what could happen is, and I just told you at the beginning of this, the Mag 7 is lagging versus the S&P 500. They're almost as a whole down for the year, believe it or not, while the S&P is up almost double digits. Is the profit taking from those to fund SpaceX could be a thing, and then they could go down farther. But we can't predict, obviously, exactly what's going to happen. We just know that the market is not the same as it was before the SpaceX IPO, and it could cause various different things. And we also know that this isn't it, because we've also got Anthropic and OpenAI that both filed for IPO. Anthropic beat OpenAI. They were like in a race. Anthropic won by a week for filing. So I don't know when they're actually going to launch, but I did read that OpenAI was thinking about waiting until 2027. So we'll see how that goes. But yeah, it's a very interesting thing. I don't know what else to say other than it's going to be interesting to see what happens because of the IPO at these lockup periods, because that money essentially is going to come from somewhere. So we'll see where it comes from. Yeah,
I mean, the interesting thing too, especially what I think most people don't realize, and we're going to talk a little bit about taxes as we finish up, but one of the things that happens, everyone's like, I'm going to buy the S&P 500, or the S&P 500 becomes my measurement. And this becomes my issue with, it's the underlying what you don't know piece about it, which is one of the things going on with the S&P 500 right now that you're referencing. You're talking about the Mag 7 and it being kind of the biggest 7. But I think the Mag 7 make up like 20% of the S&P 500, don't they? Something like that. I mean, it's really, really close to that, right? So the year might actually be going better if it wasn't for how those positions are doing.
The S&P 493 is 100%, I know for a fact, as of the time of this recording, is beating the Mag 7. So the other 493 stocks, if you just look at those, are beating the top 7.
Okay, so but those 7 make up 20%. Why is that? Well, a lot of people talk about tax efficiency and things like that. In the S&P 500, in those indexes, they're not equal weighted. Right. They basically put $1 in, and if it keeps growing and growing, they never rebalance or take money off the top. They never take the profit. That's why it's so tax efficient. But it also can get you into a trap of if those 7 stocks making up 20% of the overall, you're driven by a lot of what's happening. The other 493 can have its effect, but it's like these become so powerful in that position. And we saw that happen in the dot-com bubble. And we're seeing that happen again, that really some of the greater risk becomes what I would even call concentrate. You end up concentrated without intending to. And then depending on, if you own multiple funds and things like that, what you may not realize is you may have 40 to 50%, depending on the funds that you own and things like that, you may have 40 to 50% of your portfolio in very, very concentrated areas. And you think you're
Yeah.
well diversified.
Right. Because you got 500 companies.
Or you got 500 companies. You may even have like 1,000 companies based on the different things that you own. But because a lot of these are not equal weighted, and we so many times, especially as the market continues to go up, and we've been dealing with and having lots of conversations with people about taxes and what that looks like. And so I thought Charlie Munger, who passed away last year, was Warren Buffett's partner at Berkshire Hathaway. And this is a great little book called The Maxims of Wall Street by Mark Skousen. It's just a bunch of little quotes and things like that. So I've been reading through it. But over the weekend, I ran into this quote from Charlie Munger, and I really think it just emphasizes what we're talking about, which is trying to minimize taxes too much is one of the great causes of really dumb mistakes in investing. If what you're trying to do is manage taxes for the sake of the portfolio, and I would say, we're not going to be able to quote the numbers here because we're waiting on our auditors to get everything back from when we've recorded this. By the time this recording plays, we'll have the audited numbers back. I'd be happy to share them with you. Everything shows us that our portfolios are outperforming their indexes even after we've been paid in a way that we're happy with and continues to kind of head in that direction. But the others, people are like, well, but we got taxes and we got other things like that. It's like, yeah, because we can't just manage the tax side, but we are being tax aware. We did go in at the end of the quarter and took the losses that we could and did some loss harvesting.
Yep.
But again, 4 years of pretty much straight up makes things difficult. I will tell everyone right now, there will be some more conversations this quarter because there are some things that have made a lot of money that it probably makes sense to take a haircut on right now and pull those back inside the portfolio because the risk of them staying too big when we go to research reveals opportunities appears to be higher than letting them. It's not, they don't need to go. It's just that it's time to take some profit off of them.
Yeah.
Do you want to comment a little bit on that before we kind of wrap up things today?
No, we're going to be identifying, that's a thing on my list in the coming days, is identifying potential candidates for a donation. I think that's just if you look at the values of our company, who we are, I think that's one of the best ways to reduce taxes is donation. So we're looking for those. Tax loss harvesting went pretty well, I think, considering the amount we're up in the last 1 year, 3 years, et cetera. I think it went pretty well. It's sort of an interesting situation. I think we're really good at what we do. So. But whenever there is something that goes down, especially in the short term, we don't have very many long-term losses. But when something does go down, it's sort of a relief, like, oh, we actually can get some losses out of this. But, we can't get that every quarter. And so we did have a good bit that we were able to harvest last week. So
and it goes back to, I think the point that I would even make is that we're not going to be 100% right on everything that we buy.
Right.
So we sit here and we talk about all these things and we've got our conviction and our discipline. Conviction and discipline doesn't mean you get everything right. I mean, that's part of the learning is sometimes you get some things wrong. And I think, I've talked to people, it's like, well, why did we buy this? It went down. It's like, well, we don't have a crystal ball.
Yeah.
Right? What we have is a consistent thesis that we've been using consistently since 2011 to manage the dividend portfolio and then duplicating that in what we have inside the growth portfolio. So it's got, what are we looking at? 15 years of a discipline of doing what it does. And so I think that really kind of gets to be the catalyst, and we'll kind of land on that. Is what we stand for are three real core principles. Think like an owner, simplicity over complexity, and research reveals opportunity. And as we follow that through and that discipline, the markets will come and go. It will give us different opportunities. We'll look at this the same way that a business owner thinks about how they run their business and what there is they're doing, as opposed to this broad investments or stock market, that we're really thinking about what we own and why we own it and the purpose of it. And we don't have to be perfect. What we need to do is just be intentional about what we do. And when we do that, I think that helps be the key to the success of what we're doing. So if you're one of our clients, and you want to talk more about this, let us know. If you're watching this video and it's been sent to you by one of our other clients, or you're interested, we'd be happy to kind of do an audit of where you are right now versus the potential of what could be happening. If you are a client and you know someone who needs to send this, I'd encourage you to send this on. But yeah, so this is our third quarter, a review of the second quarter, kind of projections on what we're seeing in the third quarter. This recording will kind of finish here, and then we'll be playing this live later this month and go into kind of a Q&A for anybody that has that. But I hope that this has been helpful. But do know that you can reach out to me, you can reach out to Carson, you can reach out to any of our advisors if you've got any other specific questions. All right, so thank you so much for joining us, and we look forward to seeing you again next time.